Hey, my friend, Barry Burns here with TopDogTrading.com, and today we're going to talk about Pinbar candlestick patterns. This can be used as a trading strategy for Forex, stocks, futures, really anything that you can plot on a chart. All right, so first of all, let's look at the formation, then we'll talk about the psychology of it, and then third, we'll talk about how to trade them most effectively. So the pattern is pretty darn simple, and there's three parts to it as I define them, by the way. I don't necessarily define things the way that they do in traditional technical analysis, if you don't know that by now, but if you watch enough of my videos, you probably have realized that. So here's how I define a pin bar. First of all, it has to be a wide range bar, and that means more than average, and I'll actually show you the I have a mathematical calculation that I use for that. But if you want to eyeball it, you can do that as well. So the range of the whole bar from low to high must be more than average. And we can quantify this. Now, the real body in real body, it's always the difference between the open and the close. So in this case, since it's red, that means it opened here and it closed down here. That real body must be narrow range. So the width of the entire, or the range of the entire bar must be wide range, but the real body must be narrow range. And part B of part 2, 2B, or not 2B, no, it is 2B, that is got to be at the bottom of the range. Now, again, you can quantify that how you want to. I would say at the very, very most liberal, you should say it's in the bottom third of the bar, maybe the bottom quarter, even the bottom 20%, just depends how you want to be it. But it's got to be open and closed narrow range and at the bottom of the bar. And that means you're going to have a wide range wick. Oh my gosh, I can't even talk today. Wide range wick. Oh my goodness, it's a good thing you don't have to know how to talk to trade. Well, I always tell people that English is my second language, but the problem is I don't have a first language, so it does make it challenging. Anyway, you're getting what you get with me. All right, so that's what this means is that from there to there, the market has rejected that value. That's a market profile term. It's rejected the value up there. So during that whole time period, whether it's a daily chart, a 3-minute chart, a 60-minute chart, whatever, during that time period of that bar, the market did test the highs. In other words, there were some people who were buying those, and they actually did. Those were filled orders. But there weren't enough people to take the other side of the trade in order to get enough momentum to keep the market moving up. And so it literally ended up rejecting these higher prices at the end of that time. And therefore, the market found value, if you will, down here. When I say the market, I mean all the participants, the masses of the global market said, no, the popular vote is that the market's not worth this, it's worth that. So that's a bearish pattern, because buyers, they're not able to get traction. People aren't willing to take the other side of their trades, okay? And there aren't enough buyers. There's a couple of different ways you can look at this dynamic, actually. So there's not enough buyers that's going to push it up and create that bullish momentum. So that's a problem for buyers, not a problem for short sellers, though, right? So you got a lot of people coming in. And well, you can see what happens with the market from there on out. And down she goes down south. So that's a bearish pattern. And a lot of people look for these at swing highs and swing lows, and they can be effective in certain situations that way. Let me show you the calculations that I use for this, by the way. I've objectified it and codified it. You don't have to, but so what I have here is I'm looking back 40 periods, okay, and the swing strength, that has to do with the different indicator that's built into this as well. But just for this, I'm looking back 40 periods, in other words, 40 bars, whatever your time interval is. Here's where the range comes in. I'm saying that I want the range of that bar to be 120% or more of the range of the last 40 bars on average. All right, and then what I've set is the open and the close, the real body. I want it to be within the top or the bottom 70%, or top or bottom 30% of the bar, however you want to look at that. All righty, so that's how I've decided to set it up. So I have very clear objective rules. You can play with those. There's no magic to these particular parameters, but that's how I've set mine to be, and I find it to be very effective. The two most important things are, well, really all three are very important. Okay, so that's how I've done it. Now, so that does bring in a nice swing high there. Okay, let's move on. So how can these be most effectively used? So by the way, here's we're just showing an opposite example. So this would be a bullish pattern, right? So bullish, bearish, I don't think I need to go through all the parameters again. You can see for bullish, we want to see a long wick at the bottom. Those are the rejected values. Open and close up here. Oh, by the way, last thing I didn't mention. I don't personally give a mouse's left patootie if the real body is green or red, either for a bullish or a bearish pin bar. For me, that doesn't matter. For some people it does. I don't care. The range of the real body is so narrow that to me, whether it's green or red, meaning did it close above or below the open, the range is so narrow that I don't see it as being very significant. So throw that in there as well. Okay, now what you want to do here, what's very important, is the context of the entire chart in which you find the pin bar. So this is everything. Everything. Do not think you can just trade pin bars all day long and make money. You cannot, you will not. So for example, here's another pin bar. Okay, now that one happens to be a doji. So again, you don't really need the open and close to be far or even separate from each other. They can be equal to each other. There's another doji. So we've got three pin bars here. Now let's analyze all three of them real quick. So this occurs in a sideways market. Okay, market's really, in fact, if we really want to, draw this in here, yeah, that pulls in a low. It's getting a little below that range as the market's moving sideways. You can see we got a lot of dojis here, but really, does it mean much? I mean, would you want to trade that? No. Why? Because there's not a good enough reward to risk ratio. So this bar, yeah, it does put in a low, but it's not a very good tradable bar because, well, we don't have a direction in the market first. What about that one? Well, that too would be a bullish pin bar technically, just looking at the one bar. But that's my point. You can't just look at one bar. We're in a narrow range. So before you use these patterns, you want to use support, you want to use resistance, and you want to use direction. You want to know what the trend of the market is. So here we get another pin bar, and this one does indeed put in a swing low, but now we've broken out of that range, and then it goes up, and then it just kind of goes sideways again. But if you took that trade, okay, at least you got some money, honey. Okay, now here's a third example. Again, not one of my favorites that I would trade, but what I do like to do, see when I like to teach what to trade and what not to trade. And I find actually this is a very key point you should note in education, that when people teach you things, they will almost always only show you when things work. I like to show you when things don't really work out that well also. Now this one's not too bad, but in fact, maybe I should do a series on that. That'd be a very good video series to do, is good techniques that don't work all the time and when they don't. So we'll do that in the future. But anyway, here again, we've got a bearish pin bar. We've made a move up. Okay, awesome. But now we're just moving sideways. And so for me, no, not going to take that signal. Not good enough. Well, market goes down a smidge here. If you're all excited about that, that's wonderful. But for me, no. Why? Because of the context of the entire chart pattern. That's the point. You need to look for these only within certain contexts. And let me show you the one that's my favorite. All right, I decided before I show you the one that's my favorite, I'll show you the opposite of what's my favorite. Okay, here's the opposite of what's my favorite to show you this. Again, like to show you what doesn't work because I think that's very, very important. You need to not only see best case scenarios, or what they say, textbook scenarios. That's what everybody shows you. And then, see, the real problem with that is then you get into your mind. It becomes part of your mindset, part of your cells that, oh, every time I see this, it's going to work. And that is not the truth at all. So in education, it's important to be shown repetition of cases that don't work so that your brain is set for that and programmed for that. So here we got a nice bullish one-bar, Pinbar, candlestick pattern. But where does it occur? By the way, look, we had another one up there. Okay, so that's a high. But now we're coming down. By the way, this black line, that's the 15 EMA. All right. So while we're coming down, that's not a time when I want to be looking even for a bullish pattern of anything. I don't care if it's engulfing. I don't care if it's a hammer pattern. By the way, these are a little different than hammer patterns. We're not going to get into the details of that. But yeah, I'm not interested in anything bullish right now. I'm only interested in something bearish. Why? Because the market's moving down. So the very first thing I always look for in trading is the direction of the market. That's number one. That's step one. Then 1B, here we go again. 1B is how early or late are we in the direction of that market. Here we're early in a new down move. So the last thing I want to do early in a new down move is to buy. I don't care what kind of candlestick pattern that the Japanese have put on there for me, or, well, obviously it's not the Japanese anymore, but they're Japanese candlestick patterns. I couldn't care less. Means zero, nothing, nada to me. That bar means nothing. It's only a one bar pattern. One bar and a $20 bill will get me a half cup of coffee at Starbucks, okay? That's what it's worth. So don't get too enamored with these things. Take them as one piece of evidence. In trading, we're always putting together pieces of evidence, and it's when we get a confluence of a number of uncorrelated variables, that's what gives us a probability scenario, and that's what we will trade. Never one thing in isolation. So here's an example of my favorite context in which to trade this. So you see that we have been below the 15 EMA, now we're above the 15 EMA. We're just using that as an example. You can use other moving averages if you want to. The point of this really is that you want to trade it early in a new uptrend and have confirmation from it. So again, this is a bullish pin bar. So as opposed to using this as a reversal pattern, which they can sometimes work actually in an extended trend, then you might want to look for them. But trend reversals are always trickier, and the win-loss ratio on them just in general is lower. So I like to get in early in a new trend and look for this as a continuation pattern early in a brand new trend. So that is my favorite personal scenario for taking it. Bam. And then up and up we go. Now look, by the way, having said that, if we scrunch this chart together a little bit here and we come all the way over here, notice we get a couple of other bullish pin bars here. Whoops. We get one there. We get one there. Were those great? Not so good, right? Not so much. Because why? We're extended in a new uptrend. So once we get extended in an uptrend, then I'm not really looking for bullish patterns, and it's just the old saying that the trend is your friend until the end. So at the end, I am not looking to trade with the trend anymore. In fact, I might be actually looking to go against the trend, because if the trend is my enemy, well, then the opposite of the trend reversals, become my friend. So the best place for me in looking for these bullish or bearish pin bars is bullish in a new uptrend or a bearish pin bar in a new downtrend. So if you found the video helpful and you like what you're learning here, obviously I'm giving all this away for free. Feel free to subscribe. Click the thumbs up icon below, and your comments are very valuable to me as well. Leave any comments you would like or any requests you have for future videos. And also, the best thing you can really do is to share the video with others. Share good things with good people. If you share the video, then I'd be very, very grateful. And finally, I do have a course that I'm giving away absolutely free. So you can get that along with one of my favorite trade strategies. So the course I'm giving away for free is not just general theories or ideas. The course actually has a viable trade strategy that I just plop in your hands for free and test it out, paper trade it, simulate trade it, and hey, I hope you start making some money before anything else. That's the bottom line, but test it first. So it's called the rubber band strategy, and you can get that by clicking in that icon in the top the top right hand corner of the video screen. It's actually in green. Having trouble talking today, but that's all right. I wanted to get this video out to you this week because I was running a little bit late this week in getting my weekly videos out. So hope you found value in this, and yeah, get that trade strategy, the rubber band trade. You're gonna love it, and test it for yourself and make it prove itself to you before you place real money on it, or heck, even before you buy any trading courses. If you can get a free trade strategy and make money with it, why not do it for free? So that's my gift to you.